Hi, thank you for purchasing the SI Stop Iceberg Indicator Setups and Educational course by Scott Pulcini. That's me, and new for 2023. There's a couple disclaimers we'll go through. This is in the PowerPoint. I also play this short video before every section, which is about 1 minute.
Risk disclosure statement. There is a risk of loss in trading stocks, ETFs, commodity futures, derivatives, options, forex, and cryptocurrencies. This risk can be substantial, and therefore investors should carefully consider their financial stability prior to trading. Past performance is not indicative of future performance. The software, strategies, chat rooms, websites, and any associated websites are digital venues for educational purposes only and should not be construed as an express or implied promise or guarantee that you will profit or that losses may be limited in any manner whatsoever. Users of the information accept sole responsibility for the outcomes of their deployment, and ScottPulciniTrader, LLC, and any associated companies, agents, management, owners, and customers harmless without reservation. Please trade responsibly. Commodity Futures Trading Commission, CFTC, Rule 4.41. Hypothetical and simulated trading performance results have certain inherent limitations, some of which are described herein. No representation is being made that any account holder is likely to achieve profits or losses similar to those shown. In fact, there are frequently sharp differences between hypothetical or simulated performance results and the actual results subsequently achieved by any particular trading program. One of the limitations of hypothetical performance results is that they are generally prepared with the benefit of hindsight. In addition, hypothetical trading does not involve financial risk, and no hypothetical trading record can completely account for the impact of financial risk in actual trading. For example, the ability to withstand losses or adhere to a particular trading program in spite of trading losses are material points which can also adversely affect actual trading results. Because these trades have not actually been executed, the hypothetical results may have under or overcompensated for the impact, if any, of certain market factors such as lack of liquidity. There are numerous other factors related to the markets in general or to the implementation of any specific trading program which cannot be fully accounted for in simulated trading or in the preparation of hypothetical performance results and all, of which can adversely affect actual trading results.
Okay, a little bit about my trading history. Started trading ES E-mini futures in 2001. I lost money every day for my first 2 months, including $2,500 the first day trading one lots, which is very, very difficult to do. That wasn't putting on a trade and holding it. That was actually scalping, which is even harder to do. So basically, on the brink of getting fired my very first day. So I started, I knew I was up against it right away as far as not surviving at my firm. So I started watching order flow in various markets, basically 24 hours a day. I would obviously go and take a break, but then I would come back and then watch, the European markets, the German DAX, the Bund, just to try to understand what was happening in the markets as far as order flow. And then one day the light finally went on and I took off. And, after I started to make money, very good money, I was averaging about 50,000 round turns a day, which is over a million contracts a month. And also made $15 million scalping the E-mini S&P futures from 2002 to 2004. What's important to know is the setups I trade of and teach are based on my experience trading the millions of contracts over my career personally and against other large traders. So again, this is my personal experience. These are not hypothetical examples. It's actually how I used to react as a large trader, and when I was, caught in orders, or couldn't get out of positions, or going against me, so on and so forth. And then also against other large traders, I would see how they would trade and react, because back then you could see counterparty, and I can see exactly what these other traders were doing. So rest assured, what you're learning here is not hypothetical. It's actually based off real market participant activity and how they react to these major events that we're going to learn. So the CME actually has the two different data feeds, the market by price, MBP, and the MBO, market by order data. So the MBP has been around for a long time, up to 2017, 1983 to 2017, and it's only summary information for a maximum of the top 10 price levels and consolidates all the quantity into a single update for each price level, including total quantity and number of orders. Individual queue position and order sizes cannot be determined with a high degree of accuracy. So, the important thing here is if you're looking at MBP data and you're looking at this DOM, depth of market, DOM is just short for depth of market, and you look at this and you can see all of these prices, or all these quantities on all these prices. Well, if you're getting MBP data, all you're seeing is, which was the only thing available up until 2017, is the top 10, somewhere right around there, the top 10 order quantities for prices, top 10 price levels, right above and below. So anything you see beyond that, no matter what data feed you're looking at, you'll see orders in the order book, or what you think are orders, but they're not real orders. They're not accurate, right? Because they're not reading that actual size. So one of the main benefits of the MBO data is you can see full depth of market, meaning you can see every quantity you see in here is accurate, right? And then that's what you see in the liquidity and the heat map and book map. We'll talk about that a little bit, but that is one of the main advantages. The orders you see in the order book up and down the ladder are real orders in the order book, right? That's very important to know. And then the other thing is the individual queue position. So which is a big advantage. So if you put an order in, say if you put an order in at this price, you will know, say you have a 10 lot you want to trade and you put it in, well, you'll know where you are in the queue to get filled, right? So there may only be 4 orders here and you would be number 4 if you put it in, right now on top of this order. But that's good to know. As quantity stacks up here, you can be like, I'm in the front of the queue. And then why that's an advantage is because if you get filled first and you still have some behind you, some orders behind you that came in after you, because this is the way they structured is first in, first out type of order filling. You can make better decisions. So when I was a large scalper, there would be, say there would be like 1,000 in the back then there were these quantities in the E-mini S&P, not anymore, but there would be 1,000 lot there, and then I would drop in a 500 lot or whatever, and then it would stack up, and then it would be like 4,000 total at that price. Well, I knew I was pretty close to the front of the queue, as they call it. So meaning if someone comes in and buys 1,500, well, there's still another 2,500 behind me where I can make better decisions, right? I can say, okay, I'm going to turn around and scratch this trade. It looks like it's going to blow through. With the remaining 2,500 still there, I could just turn around and buy that to get out of my position. That's a lot different story. If you're at the end of the queue, well, it's usually going to blow through, right? So if there's 4,000 here and you put your order in, well, if it trades 4,000 in your last order, it's most likely blowing through that price. You can't make a decision quick enough to be like, okay, I'm going to scratch this, so on and so forth. So it's very good information to know where you are in the queue as well. We're not going to really cover that in this course, but that's just some more of the enhanced data that you're getting from the MBO data. And that's this. That's been around from 2017 to present. It's an order-based data feed that provides the ability to view full depth of order book, which we covered, the entire price ladder displaying real orders and the size of individual orders and queue positions of those orders. So again, you can see the queue position of the orders, of your orders, where you're at in the queue, and increased transparency. Obviously, improved understanding of the central limit order book as details of the orders are making up the book available. So, the main factor, and before we get into that, actually, here is the CME page that describes the benefits of the new MBO data. You click on this link in the PowerPoint to bring you to this page, but it's basically like we talked about: increased transparency, customer anonymity, full depth of book, known queue position. All these different advantages over MVP. What is shocking to me to this day, and we'll get into this, Rhythmic data feed is the only data feed that provides this MBO data. So all these other providers that certain traders are using, I won't start naming names, but they are using MVP, and that is not the enhanced data. And I can't for the life of me figure out why more have not moved to this enhanced data. And they're using, I do know why, because this is way more, the MBO is way more expensive to use, disseminate, so on and so forth. So just know if you are using anything other than a Rhythmic data feed, you are not getting the MBO data, right? And the MBO data is what drives the stop iceberg indicator, right? And that's what we're leading into here. So icebergs and stop runs are two types of orders that can now be disseminated with 100% accuracy with the proper software, aka Bookmap. So the developers at Bookmap have found a way to, write algorithms and programs to read this volume to determine what is an iceberg, what is a stop run, which is the foundation of my trading and the most powerful edge that you will ever see, which we'll go over here at length. So icebergs are hidden orders in the order book that only have to display a fraction of the quantity in the DOM, the depth of market, and then executed when trading into. So you can visualize it literally like an iceberg. So here's the ocean, here's the iceberg, here's the tip, and here's the rest of the huge iceberg, aka Titanic. That's actually one of our setups, right? So what the Titanic ran into. So when you're trading, if someone's trading an iceberg, say they have 1,000 lot that they want to execute, all they have to show, and this is still for, I believe it's 10%. They may have changed it to CME what they require a firm show of their order. Let's just stay with 10%, meaning if they have 1,000 lot iceberg that they need to get off, say they want to buy here, well, all they have to display is 100 lot in the order book, and then there's 900 below it, right? So that is really important information to know. And a lot of traders, so say we're moving down, remember this, say this is a bid, we're moving down and traders see 100 lot, they're like, okay, we're going to swipe that and push this market lower, and they swipe that and then they find out there's 900 behind it, right? And that stops the market many times and it rips the other way. So that is the importance of the icebergs. One, understanding what these big firms are doing. They can't display in this day and age with algorithms, they cannot just drop in the 1,000 lot in the order book. If they do that, these algorithms pick up that size and they will run the market away from the order to try to get them to chase the order, right, for worse prices, because they know what they're trying to do. So that's why these big firms have to submit their orders via icebergs if they have big size they want to trade, because they can't flash it, and that's obviously very important information for us, as traders, to be able to know, where this actually fired off. So, they're trying to hide their orders, but we actually, in essence, can see these orders. Yes, they have to be traded into, but you can know the area that this occurred and take advantage of it. And that's the whole basis of this course and my trading methodology, which we will get into at length. We talked about this. So there's two types of icebergs: native and synthetic. So native are what we'll be covering in this course. And we'll go over this briefly. The synthetic, but the native are CME held icebergs, allowing traders to place iceberg orders directly through the exchange and managed by the exchange themselves. All new orders are submitted as modifications of the initial order, which means that the original order ID is preserved throughout the lifetime of the iceberg. That's how they determine if it's an iceberg, because they can tell, they meaning the bookmap developers with the software, where if an order gets traded into, that 1,000 lot or the 100 lot, and then it keeps replenishing, well, they can see the order ID number, whatever it is. It's like a 6-digit number or something, 154, 150, 154. Sorry for the art drawing there. But then they'll see, 155, 156, every order that trades, and then they know it's all part of one order, right? That is very important information to have. And the bookmap SI indicator detects this most common type of iceberg and is 100% accurate. So they know exactly with 100% accuracy if these orders are iceberg orders, right? Which is the ultimate edge to know that. And then the other type of iceberg order, bookmap does have this available. We'll go over this. This is what they actually used before the MBO data came out, before 2017. It's the synthetic iceberg. Synthetic icebergs are submitted by the independent software vendors, ISVs for short, and they do it for firms and brokers and replenishes the orders themselves as the orders get traded into. These orders are indistinguishable from regular limit orders and how they are processed by the exchange, so they can only be detected relying on a set of assumptions. This is important. We'll go over that on the next slide. Bookmap was able to originally estimate these types of order before the MBO data became available, but produces false positives, which makes them less reliable and inherently speculative and more expensive to execute, right? So the native, once again, going back to this slide, the native are held by the CME, so they're much cheaper to execute, right? That's why the majority of firms, you just use the native iceberg. Some try to do additional hiding by using synthetic, but it's more expensive, and you have to have, again, an ISV put them in for you, software vendor, and they're also more complicated, where you have to kind of refresh the iceberg by hand. It's not by hand, it's by an algorithm, but it's a lot more tedious and time consuming and expensive for the synthetic. That's why the majority of icebergs you see are the native icebergs, right? So again, what we're going to be looking at, the SI subchart and on-chart display the CME native icebergs and are 100% accurate. The strength level indicator, which we'll look at briefly, you can still access that. It attempts to show the synthetic icebergs, but can produce false positives as it is reading traded volume versus what is shown in the depth of market, the DOM, and can change very quickly. So, they're trying to read, again, back to our original example, if there's a 1,000 lot iceberg there and it's showing 100 lot in the order book, and they see 1,000 and it trades and the price just spins and they see 1,000 traded, well, they can pretty much determine that 900 was behind that and all of that was an iceberg. But again, there's no market order IDs for one, so you can't really tell. Two, the refresh rate, a lot of firms, we're talking like hundreds of milliseconds that these orders come in and pull, put in, pull. So, it could start trading in it, they could pull it, they could start trading it. So a lot of false positives. That's why they don't even really talk about this much in the bookmap anymore. It's more this SI subchart because it's 100% accurate. So just know it's available. We'll cover that, where you can access that and look at it. But again, my main trading is based on this SI subchart and on chart. And then the other huge important angle is the stop runs. So stop runs are usually retail traders puking out of positions, right? So most of you know, as traders, a stop run, you better be using them if you're not. But so say you sell a price, you sell a 50 lot, and then you say, okay, well, if I'm wrong, if it gets up to this price, I want to get out, and I don't want to be just staring at it and having to click to get out of that order. I'm going to put a stop order in, meaning if the market comes up, you pick your price, and you have that stop order resting there, and if the price trades, it just automatically triggers your 50 lot and you get out of your short, right? So most of the time, yes, you can initiate trades as stop orders, but most of the time when they are aggregate, there's a bunch in one area, that is usually the retail trader puking, and they're a lot of times very, very reliable in where they're at, like the high a day, low a day, things like that, where you're certain they're stop runs. And I find it amusing that a lot of educators out there, and I'm using air quotes when I say educators, they claim these areas are stop runs, just because it's a high a day or low a day, things like that. Yes, most likely, but they don't know for sure. If you're using the SI indicator, you know for sure what are stop runs. And again, they're based on order IDs and the dissemination by book map, so 100% certainty that certain areas are stop runs. Why is that important? Because like I said, that is not initiative, most of the time initiative buying or selling. It is our guys, girls, traders puking at areas. Again, that's important because if you see a stop run, it's not usually initiative buying or selling, right? So that's important to me as a trader, knowing, okay, we come up to a very important resistance level and I see buying. So again, on the book map, we'll get into this as we go, but we're looking at this and say we get into an important area here. And this is not an example of stop runs. I'm just giving you something here where actually there was a stop run here, but yeah, you can see here. We'll get into all this stuff later, but the point is, you see all these blue buying. Okay, you're like, okay, it's initiative because you're not seeing stop runs, and all of a sudden you see a stop run, and many times, so this one actually kept going. We do have a name for this setup we'll get into, like I said, but many times you'll see instant rejection, right? Just meaning that the buying, you see the blue bubbles on book map, or green you guys may be using, but it's not initiative buying. It's just traders puking, and many times that is the stopping point for important areas. Again, we'll get into that. I kind of digress there. I'm just trying to explain to you guys the difference between these orders. So the bottom line is this SI indicator, bookmap SI indicator, is the ultimate edge. There, in my 23 plus years in futures trading, it's the most powerful edge I have ever seen. It is the basis foundation of my trading, and the information provided by the subchart and on-chart indicators will enhance any area the individual trader deems important. Again, I'm not telling you guys what to look at. You may use whatever indicators you're looking at. I can promise you, if you're using this information to understand these areas and how to trade them and take advantage of them, they will enhance your trading. And I don't care how great of a trader you are, you still don't have all the information, right? Traders do not have all the information about markets, so they do not have the SI indicator and are at a distinct disadvantage. So if you're already a profitable trader, well, if you have this information, you're going to be even better. And I will guarantee it, right? So again, this is the foundation of my trading, and we're going to get into how to trade these areas and understand them in these next chapters.